Okay, so 20 divided by 70. Okay, so 20 divided by 70, 20 divided by 70, we get here 28.57%. Okay, 28.57%. Okay, this is our margin of safety ratio. Final answers, 20,000 units, 8 million pesos, 28.57%. Okay. Letter D, net profit ratio. Net profit ratio. Well, we have to compute for the profit. How do you compute for the profit? Sige, so meron tayong units sold. Tama ba? Gagawin ko lang dyan, units sold times contribution margin of 140 and then ma-minus ko yung fixed cost. Sige nga, 70,000 times CM per unit of 140 times 140 minus fixed cost of 7 million. 7 million. Tama ba? Our profit is 2.8 million, right? 2.8 million of profit, and we know our sales is 28 million, right? So, sum mo na ko 28 million. 70,000 times 400, that's your sales. Got it? So, 2.8 million of profit. We divide this by 28 million. Obviously, that's 10%. Okay? Our profit ratio, net profit ratio is 10%. Okay? 2.8 million divided by 28 million. So that's your net profit ratio. Again, if it's ratio, your denominator is always sales. Well, for CVP analysis. Let's go to letter E. Okay. If sales increase by 450,000, how much would you expect profits to increase? This is an example of sensitivity analysis. Tama. So, example siya of your sensitivity analysis. If sales increase by 450, how much would you expect profit to increase? Well, you can recompute the income statement, pero we know from these numbers na you have a profit. Tama ba? Yung profit natin is 2.8 million. Na-compute natin for letter D. It means, yung increase of in your sales, let's go back to the formula. Since alam natin na may profit tayo, whenever magbebenta ka, for each additional unit, you know na yung effect of the profit is equal to your contribution margin, right? Because na-cover na natin yung fixed cost. It means, the fastest way to compute for this is basically 450,000 sales. Multiply ko lang yan by the CM ratio of 35%. Okay? Since again, once ma-cover mo na yung fixed cost, yung effect to your profit is basically equal to your contribution margin. This is sales. This is the CM ratio, 35%. We multiply 450,000 times 0.35. You get here 157,500. Okay? The increase in your profit, if your sales increased by 450,000, is 157,500. Okay, let's move on to our two remaining exercises. Okay, very easy. Modern Ink sells a product to retailers for 200. The unit variable cost is 40 with a selling commission of 10%. Is the selling commission fixed or variable? Obviously, variable because it's based on your sales. Fixed manufacturing cost, 1 million per month. Fixed selling and admin, 420,000. Income tax rate is 30%. The target sales after tax income is 123,200 would be. Okay. Just to recap, para lang din siyang break-even point except that we added desired profit. And highlight you earlier, your desired profit should be income before tax. Okay. Fixed cost or numerator muna. Fixed cost is 1 million plus 420,000. 1,420,000 plus our desired income is 123,200. I-gross up natin siya. Since tax rate mo is 30%, we use 70%. 123,200. 123,200 divided by 0.7, you get 176,000 plus 176,000. Because in the choices, you notice units yan. It means our denominator should be CM per unit. Got it? So let's compute. How do you compute for the CM per unit? Well, meron kang selling price of 200. You have variable cost of 40. Pero hindi lang yung variable cost, you still have selling commission, right? 10% daw. So it means 10% of the selling price, which is 20. Got it? 200 minus 40 minus 20, you get here 140. 40. 1 4 20,000 plus 176,000 divided by 140. See, let's see. 1 4 20,000 plus 176,000 divided by 140. You get 11,400 units, which is 400 units. Letter B. Okay, first class corp. First class corp. So you have Pinnacle, you have Modern, you have first class.
Headshot. Opponent.
First class corp has sales of 200,000, contribution margin of 20%,
You fought well.
and the margin of safety of 80,000. What is first class
kills
corp?
remaining.
Fixed cost. Okay, we have to know yung formula natin for margin of safety because we're given margin of safety of 80,000, right? To recap, margin of safety is equal to your actual sales or planned sales less your break-even point, right? And plug in lang natin yung formula. Margin of safety
We tend
is
to dust.
80,000. 80,000 is equal to sales 200,000, right? Minus break-even point.
Gecko's gone.
Break-even point, we have,
Enemy down.
well, yung fixed cost, hindi natin alam because there's a question. So, fixed cost, lagay lang natin sa numerator, divide by CMR of. So, algebra lang. Actually, in CVP analysis, especially in answering sensitivity analysis, algebra yung ginagamit natin dyan. Okay? So, how do you compute the fixed cost? Basic
kills
algebra,
remaining.
paano mo ma-eliminate yung 20%? You multiply yung 80,000 by 20%, right? 200,000 by 20%. 80,000 times 20%, that's 16,000. 200,000 times 20%, that's 40,000. Minus fixed cost. Got it? So, if i-shuffle natin siya, tama ba? Your fixed cost is equal to 40 minus 16,000, 24,000. Letter B.
That's the end of this free tutorial. Patikim pa lang yan.
Rest.
You are selling multiple products.
One kill remaining.
How do you compute the
Just one
break-even
more.
point and margin of safety? What if graphic stores naman ginagawa sa atin sa problem? How do you you're given the profit ratio, margin of safety,
Now to mend what we have broken.
turo namin lahat yan. Pinakels, regardless of your account.